Good morning, everyone, and thank you very much for joining us this morning. It's our Q2 China webinar update. I'm Darby Carstens, and I'm joined by Tian, who's head of our product in our China business. Tian is joining us from Canada this morning. He's recently is a new father, so congratulations on that, Tian. I hope you're still having the honeymoon phase and having enough sleep. As with all our webinars, please post your questions in the Q&A function, and we'll get to as many as we can at the end. Tian, before I hand over to you, I saw that there was an article in News 24 this morning, and it's something I think a lot of people sometimes miss, as you touched on it, or I think the article is about it, is that SA investors are mainly overweight Hong Kong versus mainland China. So maybe we can start with that before you go into sort of the unpacking what's been happening over the last quarter. Over to you.
Cool, thanks, Darby, and morning, everyone. Thank you for joining this morning. Now, just to follow on from what Darby mentioned, I did an interview with News 24, just talking about availability of China investment options for South African investors, and it's actually extremely limited, and coverage of South African options in China largely focus on the offshore listed Chinese stocks, which have historically been very focused on technology. So everybody knows Tencent, Alibaba, but not everybody knows a lot of Chinese companies that are listed and operate on a massive scale inside mainland China. And now we'll actually cover one or two companies like that in today's presentation. But yeah, pop over to News 24, read the article. I think it's quite interesting just to understand there's an entire different Chinese market that Prescient tries to cover for South African investors. So with that, I'm going to jump straight into today's presentation. I think quite a roller coaster ride for Q2. Quite a lot of things happening, or that had happened. Actually, some very recently in July, not exactly in Q2, but I will cover it slightly. So firstly, I think we will go through some economy and policy updates. Very quickly, I think GDP for Q2 year-on-year 2024 came in under expectations at 4.7%. Not really much of a worry. The overall target for the year for the Chinese government is around 5%. Their stated target is 5%. Q1 was 5.3%. Q2 was 4.7%. They are under a bit of pressure to hit that 5 target if the trend is downwards for the remainder of the year, which is why we are seeing more supportive policies come through to try and hit that 5% target. So it's actually a small missed, a number that sort of slightly missed expectations. It actually feels like a positive for us because it kind of makes the 5% achievable, and it actually adds pressure on government to put through more policy. So the second bullet point on this slide, investments share of GDP actually going up. So you can see investments obviously made up, this is total investment in the economy. It's made up of a lot of government-driven infrastructure investment, FDI, etc. But we are seeing an increase in investment share of GDP, which is showing the government is trying to act to boost overall economy. CPI is still steady, slightly above zero. Core CPI also steady. PPI negative 0.8, so it is still negative, but less negative from last month and last quarter. So PPI is getting better. Retail sales, a disappointing 2% increase from a year ago. Largely driven, we believe, especially for the June number, largely driven by a year-on-year drop in car sales. And also, there's been quite a lot of natural disasters in China, especially in the southern region. There are typhoons going on there right now and a lot of flooding. So that actually restricts people's movement and kind of puts a pause on a lot of in-person consumption. So we are seeing some seasonality weather-related. So we're going to look forward to another number for Q3. We expect that number to improve, assuming weather and everything improves in southern China, which is actually looking terrible right now. But nevertheless, still an increase from a year ago. So GDP economic numbers are looking steady, if not amazing. So nothing terrible, nothing great. So with that, I'll move on to investor sentiments. Some of you that attended my presentation at Meet the Managers this year would have seen this chart. It's been extended. So this is net foreign investor flows into the China onshore market, which is the mainland Chinese equity markets. You can see that for 2023, it was quarter 2, 3, and 4 was complete net outflows. For the first quarter of 2024, very strong inflows. By end of May, we had almost doubled the entire 2023's net inflows into Chinese equity markets from foreign investors. But by the end of June, we had, just for the month of June alone, we had a net outflow of 44 billion CNY. So these numbers relative to the size of the entire market are small, but it just shows that how sensitive investor sentiment can be based on data releases that are actually not majorly positive or negative. We are still positive for the year. We are trending sort of flattish for July, as economic numbers and sort of retail confidence numbers come through. These sort of flow numbers do have a lot of volatility in it. So we continue to monitor these numbers as part of our sentiment models. But this slide is just to show that sentiment was very positive January to May. It is becoming a little bit wobbly in June, July, but we are still positive for the year and we continue to monitor that. So, one of the most talked about things was the third plenum meetings. It's sort of twice a decade, once every 5 years. There had been media reports saying that they hope for positive stimulus policies to come through. And we had consistently been saying to clients that we do not expect any sort of short-term stimulus policies to come through from the third plenum meetings. These have historically been, for over decades, been extremely long-term economic planning policies. And it typically gives economic policy direction, not even detailed policies themselves. So this time wasn't any, there were no surprises. So sort of the main things that were announced from the third plenum meetings, that the government wanted to obviously improve self-sufficiency in supply chains, especially in the tech supply chain, where there's a lot of US sanctions on China. There's been a commitment to continue to open up the Chinese economy for trade investment, to attract more foreign direct investment, and also to reform the state-owned enterprise sector and support the private sector. All of these are positive intentions. How they play out, we'll need to look at least for the next 5 years. We don't have any detailed policies currently. In terms of financial sector reform, also positive, but then again, I think another reminder, all of these are long-term policy directions. So we still need to see the detailed policies as we go through year by year to see if all of these are actually being done. Typically, if history is anything to go by, the government does actually act on all of these long-term policies. So it's positive in terms of financial reform. The finance sector, there's reiteration that the finance sector or the financial markets not for speculation, but it's there to serve the function of the entire economy, including the real economy. The regulators want to improve the capital markets, ensure the quality of listed companies, reduce frauds, to make sure that it's long-term capital friendly. If anyone knows anything about Chinese financial markets, capital is very short-term made. The capital invested in the stock market turnover rates very, very high, largely due to the retail influence as well. But there is now a focus to ensure that investments in the stock market and the financial markets are more trending towards the long term, and regulation, accountability, etc., for protection for investors. That's been the theme for financial regulation for the past 5 years already. So that's nothing new. So overall, positive policy direction from the third plenum meetings, and nothing that'll be a major surprise in the short term, but all positive nevertheless. And we wait to see how all the little details play out as we go along. Moving on, some short-term policy that came through last week to add confidence to the markets. Separate, they pretty much came through right after the third plenum meeting, so you can say they were related, but not exactly part of the third plenum meeting. So we saw first interest rate cuts in a long time, both in the 7-day reverse repo rate and the 1-year medium-term funding rates, 10 and 20 basis points cut. It's a very positive sign from the central bank that it's more of an intention of support. What we are seeing on the ground in China is that there's no lack of funding. There's no the cost of funding is actually already very low. I think the last sort of box we need to tick is for businesses to gain the confidence again to ask for funding. I think one of the issues is that there's not really a lot of confidence for applying for funding currently, and we hope that the government will encourage more of that. We don't expect a lot more interest rate cuts, especially if the Fed doesn't cut. There's less room for the Chinese central bank to move. It just creates a bigger interest rate gap and more pressure on the CNY currency. So nevertheless, a positive policy is coming through just last week. If we look at confidence indicators that we've been monitoring for or sharing with clients for almost a year and a half now, PMI numbers still positive. So if we look at the blue line, which is the Taixing numbers, more representative of the private sector, both numbers are continue to be above 50 for both services and manufacturing PMI. The private sector manufacturing PMI is actually continuing to increase. So it shows the export sector is probably gaining confidence. Services sector, both the official services PMI and the Taixing PMI above 50. Official manufacturing PMI, the red line, which includes a lot of state-owned enterprises, flat compared to May. So no changes there. 49.5, slightly below 50, is small contraction territory. Overall, industry confidence still solid, not much change from Q1. Tourism spending, an indicator that we'd like to use recently to show retail consumer confidence. We pretty much just had the Dragon Boat Festival. So anyone that attended my talks in the recent couple of months, we covered the Labor Day Golden Week already. That's one of the bigger holidays in China. In June there was a Dragon Boat Festival. It's essentially a 1-day public holiday that the government stretches into 3, so it's a long weekend. Again, we are seeing increases versus 2019 pre-COVID levels, but increases are not major relative to Labor Day Golden Week because it's a much shorter holiday. It's still positive data. The next big set of numbers we're looking at is the October 1st national holidays, which I will provide in our Q3 update. And we are expecting a solid number there as well as the economy recovers. Moving on to China's tech self-sufficiency, I think that's one of the things we said we'd cover in this quarter's webinar. We actually will be sending out our quarterly commentary in the next couple of days where we cover this in slightly more detail. One of the sectors that's been doing really well is the electric vehicle sector for China. So this is a sort of chart of the top 10 electric vehicle companies in the world. The green batch is all Chinese companies, Tesla, the standalone American companies, then you have Germany and South Korea pretty much making up the top 10. You can see China by far the biggest sort of national representation. Overall, Chinese brands have around 30% of global market share. BYD is second behind Tesla and is expected to overtake Tesla in 2024. So all of these numbers are end of 2023, by the way. Pricing and competition in China is just cutthroat. It's by far the most efficient, most value for money in the world. Many of the legacy car makers that are switching into electric vehicles, they just cannot compete with the Chinese companies. So that's why we are seeing, for example, EU tariffs come through. I'll cover that in the next couple of slides. Another company that we wanted to cover briefly today is, I'm not sure if anyone has heard of CATL. It actually links to the point I mentioned about China onshore companies and offshore companies. CATL is the world's largest electric vehicle battery manufacturer. It's got almost a 40% global share in EV batteries. So 38% global market share, they supply all the top electric vehicle companies: Tesla, VW, BMW, Mercedes, General Motors, etc. All the Chinese electric vehicle companies they supply. So over the past couple of slides, BYD and CATL, two of probably the Chinese champions of the electric vehicle sector, both portfolio holdings in our Prescient China Equity Fund and Prescient China Balance Fund, although we do believe valuations of these companies are a little bit high. So we do have a slight underweight position in our fund. So these are companies that CATL is a company that you probably won't get exposure to or any meaningful exposure to via the MSCI China Index, but you do get a decent exposure via the CSI 300 onshore index that Prescient provides. So these are examples of really up-and-coming industries and up-and-coming companies that one can get access to in China, but only in the onshore market. Talking about EU tariffs on Chinese EVs. So we do cover it in our commentary as well, is given the increased competitiveness of Chinese produced electric vehicles, the European Union has now proposed a tariff increase from the current, or not current anymore, but last month or in June, it was still 10%. Now Chinese electric vehicles have to pay up to 48% tariffs for sending electric vehicles to Europe, depending on the company. So BYD, for example, is only going to pay around 27%, but SAIC, the parent company of MG, is going to pay up to 48%. Due to the different cooperative levels they have, how cooperative they were with European regulators on their investigations into overcapacity in the Chinese EV market, if I can call it that. So one of the interesting things about EU tariffs on Chinese EVs is that it's tariffs on Chinese produced EVs, but what the biggest portion of imports into Europe from China is actually foreign branded electric vehicles. So Tesla, BMW, Mercedes, etc. have major production chains in China due to the cost efficiencies and the production efficiencies. So all of these tariffs will actually hit BMW, Mercedes, and Tesla hard for all of their China-produced cars. So we are still waiting to see what the eventual tariffs will be. The final vote in EU will be in November. We are seeing a lot of sort of remedial action taken by the Chinese companies, CATL, both CATL and BYD setting up production within the EU to circumvent these tariffs. So once you produce in the EU, you don't have to pay any tariffs, not even the 10%. Previously, to give everyone an example, the BYD Dolphin, it's an entry-level electric car that's also available in South Africa. So in South Africa, I think it's around 550,000 Rand. It works out to almost 27,500 euros. In Germany, it's slightly more expensive at around 33,000 euros. This is the base model, by the way. In China, you can see it's less than half the cost of South Africa and almost a third of the cost in Germany. So this is all due to the recent tariffs. In South Africa, I believe the tariffs on EVs are around 45%. Could be mistaken, but it's a high tariff, which is why cars, once they leave China, are extremely, extremely expensive. But even with that, they are still extremely competitive relative to all other brands. So we do cover slightly more of that in our quarterly commentary, which is going out in the next couple of days. So please watch out for that. So I think all of these slides aim to show how Chinese sectors are becoming more innovative. The Chinese economy is turning from purely a contract manufacturing based economy to an innovative economy. Electric vehicle sector is just one example. Another example that we don't really have access to because it's an unlisted company is Huawei. Huawei is most famous for being probably the most sanctioned tech company in the world. It was sanctioned by the US in 2019. Sanctions just increased sort of year after year, but they recently returned to being the number one smartphone maker in China again. So they had a 41% jump in shipments in Q2, selling 10.6 million units, back to 15%. They're slightly above number two, Number two is also around 15% market share, but Huawei is back to number one in China now. The significance of this is that it shows the resilience of the Chinese economy. Huawei has been able to sort of work their way through all US tech sanctions. They are building their own operating system, Harmony OS. They are building their own chips, the Kirin chips. They are not just designing their chips like before. They are producing their own chips. They are producing their own phones now using pretty much all non-US technology. So it shows that even with US sanctions, the Chinese economy is now pretty much back on track. At least the tech sector is now becoming more and more immune to US sanctions. So the economy and the related sectors in the stock market will no longer be affected by US sanction, which is a major risk reducer for holders of Chinese equities. So another big positive. And Huawei, who would have guessed? Within China, they are challenging Nvidia. So Huawei is now the leading Chinese AI chip producer, largely because Nvidia is not allowed to sell their most advanced chips in China. So Huawei, even though they are a few generations behind Nvidia's latest tech, Huawei's chips are widely considered to be better than Nvidia's chips in China, or at least what Nvidia is able to sell in China, which is sort of their tier 2, tier 3 technology. So it actually gives Huawei room to grow. It gives them a competitive edge, which is counterintuitive because the US sanctions are limiting a US company from dominating in China. So that's the reality on the ground. Chinese tech sector really doing well, Chinese electric vehicle sector really doing well, all the other sort of non-politically sensitive industries are recovering strong. And overall, the trend is looking positive. It continues on from what we've said over the past couple of quarters. Moving on to Prescient's performance and positioning. Firstly, we go through our equity fund. This is the fund where we don't have a Rand feeder fund versions. This is our pure equity fund, and this is pure China onshore. So it only has a very small Hong Kong component. It's largely focused on stocks listed in the Shanghai and Shenzhen exchanges, the part of the Chinese equity market that has the best diversification benefits for South African investors. It shows our China equity product is an absolute ETF enhancer. So over 1 year, we've beaten the largest CSI 300 ETF in the world, net of fees, by almost 4.5%. So we've been doing quite well. Our models are working well. We're generating outperformance. This is a profile of our cumulative outperformance within our Prescient China equity fund. You can see it's fairly stable profile, so it doesn't put the risk on investors on when they come into the fund. Whenever you come to the fund, we will produce alpha consistently year after year, as probably one of the most consistent in the industry. As a result, amongst almost 2,700 active peers in Bloomberg in the China equity category, we ran consistently around top 10% globally. And in our Morningstar ratings, we are rated 5 stars for 3-year, 5-year, and overall, pretty much every single category we are rated on in Morningstar for our Prescient China equity fund. In terms of our Prescient China Balance Fund, this is our flagship South African product. It's got exposure to China offshore, China onshore, China fixed income. This is your all-in-one China product. You pretty much buy this product and we do everything for you in terms of your China allocation. In mid-May, which is during Q2, markets were doing really well. We were at one stage almost up to 98% equity exposure. By the way, for those that are unfamiliar with our Prescient China Balance Fund, the balance name is a bit misleading. It is a fully flexible China allocation fund. So we can go up to 100% equities. We can go down to 0% equities. Historically, we've gone up to as high as 100, probably only as low as about 36, 37 because the markets haven't been that poor. But it's fully flexible. So over course of Q2, at one stage, we went up to 98% equities. As we stand now, as at the end of last week, so in Q3, sentiment has been a bit volatile. So we started reducing our equity exposure. We are still very aggressively positioned. We are around 81% equities in the fund, with 17% of the fund protected. So we pretty much only have around 64-65% exposure to the downside currently. And over the long term, we manage the asset allocation extremely actively. For those of you that are invested, you guys will know how we perform over the quarter. Even though the markets were down, our Prescient China Balance Fund produced a positive return. It's been a tough quarter. It's been a roller coaster ride. Markets did really well in April and May, and then did really badly in June, ending up slightly down. But the fund was actually up net of fees, so we're quite happy with that. We continue to push for outperformance and absolute performance in the fund. Since the inception, over more than 11 years, the blue line on this chart is our Prescient China Balance Fund. We have outperformed all major equity indices that are China related. So both MSCI China and CSI 300, all of these indices are total return indices. And the Prescient performance numbers on this chart are net of fees. So everything is net of fees, and we've been able to outperform pure equity indices with our Prescient China Balance on the fully flexible allocation fund. Shows the strength of our dynamic asset allocation process. In terms of Morningstar ratings, we are rated 5-star over the long term. Over the short term, due to the poor overall performance of Chinese equity markets over the last 3 years, we are starting to underperform some fixed income funds in our category. So we are now down to 4-star. But over the long term, we are very confident in our robust asset allocation process to generate strong real returns. Okay, so I think that's it for almost it for today's webinar. To summarize, the Chinese economy continues to be very solid in terms of its recovery. China tech is developing really solidly, although we believe a lot of the AI-related tech valuations and EV-related electric vehicle sector valuations are quite high. We still maintain exposure to it, although slight underweights. Policy remains supportive. We continue to expect policies to come through in the next couple of quarters to ensure a steady economic recovery towards that 5% GDP growth number. US elections will continue to produce China bashing noise. We haven't covered too much of that this quarter. We just wanted to wait for the sort of news flow in the US to quieten down a bit with the Trump assassination attempt and sort of Biden falling out of the race. We will have more of an update on China-US relations next quarter. But we do expect more China bashing as we run up to the elections either way. And last point, valuation remains extremely attractive. Valuations pretty much haven't changed since April. They did get slightly more expensive by May, but since end of quarter one compared to end of quarter two, valuations are very similar. Not as cheap as January, but still very attractive. And we still believe it's a once-in-a-decade opportunity to increase your China exposure, especially in the onshore market, as I mentioned earlier. And that's it. I think the last chart, I've showed this chart last month or two, is that when Chinese markets rally, they rally really quickly. So this is a historical performance of CSI 300 from the lows. Right now, we are at a low. We don't expect the 616% performance back in 2006, 2007 again, but it's very clear to see the trend. We are at a trough, and when market sentiment does return, we do expect a very strong rally to come through. Yeah, with that, we open up for questions.
Thank you, Tian. Nice and to the point. A couple of questions that's come through. Maybe just to start off with, you mentioned Mainland and Hong Kong. Maybe just differentiate again between Mainland, Hong Kong, MSCI China, and why for a SA investor it's perhaps better to look at Mainland versus, say, MSCI or Hong Kong.
Yeah, so I mean, it's all China, so it is confusing. So, for example, the MSCI China Index actually has almost, I think it's something like 650 something stocks, but the heaviest weights are your Hong Kong listed China offshore stocks, and you're pretty much getting majority tech sector exposure. Whereas in mainland China, you're getting quite a wide exposure to real economic sectors and real GDP growth. So if the Chinese economy grows by 5% overall, you're more likely to get a number close to that 5% GDP growth in the CSI 300 index rather than the tech sector. The tech sector can be crashing, but the economy can be growing. The concentration risk is just too much in our view if you just stick to China offshore. We don't believe you should totally not have China offshore, which is why within our Prescient China Balance Fund, we have exposure to both. If you just purely look at market cap and size of the market, the Hong Kong market is about a quarter of the overall Chinese market, and the onshore market in mainland China is about 3/4. So typically our neutral weight, if you want full China equity exposure, would be a 25-75 split between the two. But if one had to pick a single market, the onshore market is by far the best diversifier for South African investors. I mean, South African Reg 28 investors need to have a large portion, or mostly have a large portion, in SA equities, and Chinese onshore equities, as represented by the CSI 300, is by far the best diversifier for South African equities listed on the JSE.
Cool, thanks. Property market, covered a bit of it, but it's a key component of the economy. Perhaps any comment regarding restoring the property market and sort of building consumer confidence or investor confidence in China?
So during Q1 and Q2, the government and state-owned banks pretty much released about 2 trillion CNY of funding towards the property sector to stabilize it. So it's been too short. It hasn't been too long. There haven't been any new policies in the last month or two. But the property sector, I think we've said for more than 2 years now, is going to be a drag on the economy. But it's at least within Prescient portfolios, it's been a negligible component since about 2018. So at least in our strategies, one doesn't have to worry about direct property exposure. We continue to expect the property sector in China to be on a path of managed decline. It's going to be we expect it to be an annual drag of 1 to 1.5% of GDP growth. So that's why without the property drag, Chinese economy is probably going to be growing at 6.5% this year. But we do have the property sector issues, which is why we're growing at 5%. Still a great number, but it could be better. So, the property cycles are extremely long. We expect it to be a slow managed decline. But it shouldn't cause any major issues in the economy.
Thanks. On the back of that, shadow banking risks. How is China addressed the risk associated with shadow banking, and what measures have been taken to enhance the financial stability?
Shadow banking is a problem. So a lot of local government financing vehicles. So we do have a lot of local governments heavily in debt that are unable to repay. The good thing is that Chinese overall government debt to GDP ratio is still low. So there's a lot of capacity for central government to bail out local government. So that's the one sector. A lot of the other sort of shadow banking financing vehicles have already collapsed, largely related in the property sector. But I think we've been saying it for years now, is that the banks in China have been very clever to ensure that they had no exposure. So how the funding of the shadow banking largely worked in the property sector, for example, was that financing vehicles will be formed in a trust, which would funnel or should raise funds from wealth management products from sort of your retail investors or high net worth individuals, offering them very attractive interest rates, and then get funneled through to the property sector. So you pretty much have an end-to-end sort of funding system that's outside of bank balance sheets, nothing that will really threaten the stability of the Chinese financial system. But unfortunately, a lot of wealth management product investors over the past couple of years have sort of lost a lot of their capital. We've heard of people losing anywhere between 20 to 90% of their invested capital in these sort of essentially high interest credit products. So overall, shadow banking system, it's something that's going to exist in China. It is getting more regulated and more efficient in terms of people understanding their risks, but there are a lot of defaults. But all of these together, it's not going to, I think the key points are, we don't believe it's anywhere near affecting the stability of the financial system. And in terms of local government, we don't believe it's large enough that the central bank cannot not central bank, central government cannot manage the issue. So overall, similar to the property sector, not an amazing scenario, but nothing that cannot be managed.
I guess we can't have a webinar without a geopolitical question. So first one, Russia and China. What's happening and what's the take on all the wars or risks out there? And then the second one, obviously, it's been a little bit more quiet on the Taiwan front, but I guess with the US elections coming up, what do you expect would be sort of the main drivers or noise out there again?
So firstly, Russia. I think, recently we saw a lot of Russia's actually been very, very active outside of China. So I think China has made it very clear. I think one of the things we need to understand very clearly is that China wants to be on Europe's good side. And the counterparty to the Russia-Ukraine war, at least for Russia, is pretty much Europe. Because if Russia takes over Ukraine, then Europe is pretty much its next target. One can argue. So China wanting to be in Europe's good books won't really provide. It doesn't serve China's interest to provide military support for Russia. But then again, on the other side, China's been sanctioned so hard by the US that they really don't have any choice but to be friends with Russia. So if anybody understands the history of China-Russia relations and the history of China-Ukraine relations, I think I've said that since the beginning of the war, is that China-Ukraine relations have always been better than China-Russia relations. Ukraine helped China build its first aircraft carrier. So with all of this in mind, Russia very recently has been meeting up with India, Vietnam, North Korea. So China is actually getting less and less involved, although economic and trade activity between China and Russia is at all-time highs, largely because Russia is unable to trade with the Western world due to sanctions, etc. So we don't see any major changes there. On the Taiwan front, it's actually things have actually quietened down a lot. We don't expect anything major to happen, at least prior to the US elections. There will be a lot of noise. The new Taiwanese administration has pretty much gone quiet. So things are uneventful cross-straits between mainland China and Taiwan currently. And our assessment of the risk is still that it's an absolute low probability event and continues to be a low probability event of any conflict between mainland China and Taiwan.
Thanks. Which sectors or industries in China present the most attractive investment opportunities despite the economic headwinds that China is facing?
So being a quant house, we actually don't sector pick or sort of pick concentrated portfolios. But obviously we do believe the AI sectors and the EV sectors have a lot of potential in China, although the valuations of those sectors are quite high currently, which is why we don't have overweight positions on those. One of the sectors that actually performed really well for us, been a positive alpha contributor in our portfolio, is the banking sector in China. They've revalued from about a PE of 2 to 3 to a PE of 4 to 5. So we've almost doubled our sort of valuation in the banking stocks that we've held over the past 2 years. So that's been a positive. But overall, aside from the EV and not conventional tech, but AI tech sectors, everything in China is looking extremely, extremely cheap. Valuations are cheaper than Japan at the bottom of its bubble bursting back in 1992. So we're finding pretty much 80 to 90% of Chinese stocks extremely attractive currently.
Thank you. Could you elaborate on the recent developments in state-owned enterprises reforms, and how are these reforms impacting the overall market landscape?
Yeah, so SOE reforms is something that came out of the third plenum meeting. So we actually don't have details of the new round of reforms that are coming out. What historically has been done is that to make state-owned enterprises more market orientated rather than socialist sort of state-owned entities that more provide a social purpose. But SOEs in China still provide social purposes. So, for example, the railway company operates Chinese high-speed rails at a loss, a lot of routes at a loss, more to serve a social purpose. So, and especially coming out of COVID, there's been a lot of pressure on state-owned enterprises to hire, even if they don't need, just to ensure they contribute towards low unemployment. So currently, probably not the most market-oriented companies domestically, but they are serving a wider purpose domestically and a positive purpose in our view currently. But yeah, we will wait for new sort of reform details to come through. I think the intention is that to level the playing field for state-owned and private enterprises, at least in the local markets, so that SOEs historically just had favorable policies and favorable funding rates, favorable access to funding, everything. I think the intention probably for the next 5 years is to level the playing field for state-owned and private enterprises.
Thank you. One or two last questions, I think. So how would you say China is balancing its push for innovation and technology development with the need to protect intellectual property rights? And what policies or initiatives are in place to foster innovation while maintaining fair competition?
So this is a very good question. So historically, China has, or when I say historically, let's say 20 years ago, China was not probably the most respectful intellectual property because China had no intellectual property. They were not even innovating. So it didn't really cost them to do if a Chinese company stole intellectual property from another company, there was not much incentive for China to actually put laws in place to protect intellectual property. The picture right now is completely different. If we look at number of patents being registered globally, China has consistently been the largest patent producer globally for years now. The amount of intellectual property China is producing is phenomenal. It's a J curve relative to all the other countries. So China now has a vested interest in protecting intellectual property because by doing that, they are protecting themselves. So with that, I think it's just a matter of time. We've already seen a lot of progress over the past couple of years. As one generates more intellectual property themselves, the country will become more respectful to intellectual property universally, just because that they are part of that. They have that incentive to protect their own intellectual property. So we think it's just a matter of time before China's probably got the most robust intellectual property protection laws in place. Let's give it another 5 years and we should be very good. So yeah, right now, yeah, I mean, you do have the risk of other developing countries like India, for example, stealing Chinese technology, whereas they don't innovate as much and there's no cost to them in terms of them maintaining their own intellectual property law. So China will probably become one of the victims shortly in the future of other countries stealing their intellectual property.
Thank you, Tian. Last question, I'll take that one. There was a question about how to access the fund and if they feed us. The funds on most of the platforms in South Africa, and only our balance fund is a feeder fund. We are perhaps looking at launching the equity fund as ETF, and we'll keep you posted if that does happen. So with that, Tian, thanks a lot. Thanks everyone for joining today, and we'll chat to you at the end of Q3. Have a lekker week. Bye.
Thank you, everyone.